Hey guys, and welcome back to the channel. Today I want to talk to you about electric vehicle stocks, also known as EV stocks, and my thoughts on it and whether or not you should invest in these kind of stocks. Recently we've seen a lot of electric vehicle stocks coming to the public market and coming to the stock market, and they've come there through SPACs and all that, and yeah, there has been a lot of potential in there, at least that's what people think. And yeah, I just want to go over that and share with you my thoughts and see if these are good investments. So this will be a general video, and I might dive, or I will probably dive into these type of stocks later on. But yeah, I think everybody should be made aware of all the risks that are out there, and I do not think that the current coverage is actually giving you a full picture of all the risks that are involved as well. So I came across this article some time back, about 2 months ago, as the ultimate electric vehicle investing guide, 23 electric car stocks to watch. Yeah, I'm gonna go over the list that they showed, which was these stocks. So you have Tesla, General Motors, Nikola, well it goes on. Lordstown Motors, Workhorse is the one I'm gonna be talking about today, and then you have some known companies, unknown companies. If you like electric vehicles, you probably know all of them, but there are some established car companies and some up and coming car companies. And one thing I found very particular is that the one company that I think is going to be a decent electric vehicle company, which is Volkswagen, is not on this list. So that was quite surprising to me. And yeah, there's this website called driven.io, and every month it posts how many electric vehicles are sold in Norway, and Norway is the consumer leader when it comes to electric vehicles. And yeah, you see here the Audi e-tron, the Volkswagen e-Golf, Volkswagen ID.3, so those are the top 3 sales year to date, with a combined sales of 16% of the total market, and that is all from the Volkswagen group. And then here you have the Model 3, which is at 3.3 at this point. There are a lot of Teslas in Norway, which is pretty awesome, but if you put this chart and you look at it, then you see, okay, how much market share is now being taken by other companies, which I think is very interesting. So Tesla market leader probably still overall, as far as I know, but you see that they are companies that are really getting there. And it was surprising to me that this was not on that 23 electric car stocks list, but yeah, it happens. But today I want to talk about Workhorse in specific, because I've seen a lot of YouTube videos about that, and yeah, why I think that's a very risky stock, and why all these new electric vehicle stocks are actually pretty risky in and of itself. But first off, I want to ask you guys, like, do you want a full stock analysis of Tesla from me? If you want, leave a like, and if you want something specific from that Tesla stock analysis, let me know down in the comments below. It would be several videos, of course, and I wouldn't just talk about all the tailwinds that Tesla is having right now and all the great growth. I would also look at the numbers, their revenue mix, all that, and see the potential, their factories, all that. So if you want that, please leave a like, and I'll get to that later on this year. That's at least my goal then. I came across this image on Twitter, and it was a list of public listings by companies with minimal or no revenue, and includes companies with a market capitalization of at least $1 billion at listing, with less than $500,000 in revenue in the prior 12 months. So that's what you see here. And then you see in the year 2000s, when the tech was in a bubble, you see that there are a lot of listings of tech companies or telecommunication companies, technology and e-commerce, with no revenue or barely any revenue. And then later on, in the past 5 years, you see a lot of biotechnology, which is a very difficult subject for me to talk about. At least it's very you need to know a lot about whatever the company is doing, which is very interesting but very hard to grasp, in my opinion. And then you have the yellow one, that's the electric vehicle battery. companies. And here you see Nikola, QuantumScape, which is something that is talked about recently. Lordstown Motors is talked about on YouTube a lot. So we've seen an increase this year alone in those listings. And yeah, whenever there is an event like that, you might say, or an occurrence like that, then I think we should be hesitant before making any move. The one that is not listed here is Workhorse, but I want to look at the financial statement of Workhorse real quick, and we'll just let you know what my thoughts are on it. So this is Workhorse Group Incorporated, and this is their most recent quarterly earnings report. And these are not in thousands or something like that. You see that on top there's nothing like that. So it's 560,000 net sales. And if you're in a stock group or in a growth stock, and you are still waiting for a contract like they are waiting for right now, then you cannot really expect to see consistent growth. So I'm gonna just accept that and accept that it's just a given that these growth numbers are pretty inconsistent. If you look at the previous financial statements, you will notice the inconsistency there. What is worrisome, however, is the cost of sales. So if you don't know what cost of sales are the costs directly related to the sales. And you notice that they are very high in comparison to net sales. And you might say, well, it's a growth company. It will lower these costs through economy of scale in the future or something like that. But that's the thing. The cost of sales are costs that are very hard to reduce through scale. And to show you that, I'm going to look at Tesla of the past 10 years. And Tesla has shown obviously incredible growth numbers. Like this is a growth percentage of, I believe, 70%, over 70% per year in revenue growth. And in 2010 they already had 117 million revenue in sales. But look at the cost of goods sold. So I think this is about, what would it be, 20%, and here it gets a bit the gross profit will be 20 to 25%. And just look at how the cost of goods sold increases over time, but keep in mind how it relates to the revenue. And if you see here, this is right around 20% as well, like it's a little bit lower even. So the gross profit percentage compared to revenue is about, I'd say, 18%. So it's very hard to reduce your cost of goods sold compared to the revenue. And what we notice with Workhorse is that they actually have a cost of goods sold that is way higher than the revenue, which would imply that even if the revenue increases, the cost of goods sold could also still increase. I don't think it would increase with the same amount, but they are very far away from being profitable if you look at the statement. Then we look at the assets. Keep in mind that Workhorse is trading right now at about 3.8 to 4 billion dollar market cap. They have 120 million of total assets and a total current liabilities, so liabilities that should be paid within 1 year, of 132 million. That means that there is no way that they can, with their current cash position, which is we can see that about, where is it, here it's 80 million, there is no way that they can pay the current liabilities. That means that they will need to do either get more debt, or they will need to do a equity raise to increase capital. Sure, I think in growth stock equity raises are pretty common, and if the stock right now is about 10 times higher than it was 6 months ago, so it would be kind of lucrative to use other people's money to grow your business. But for current shareholders, in a long-term perspective, equity raises are obviously not something you would like to see. And then we can look at the leadership from Workhorse, and you see the CEO, Chief Operating Officer, Chief Financial Officer. Look at how much stock they own. It's 0.3%, 0.15, 0.4. So the Vice President owns more stock than the CEO, and the ownership is 10.6 million right now. So that is quite significant. But keep in mind that the stock has increased by tenfold in the past 6 months, give or take. That would mean that 6 months ago the compensation was exactly the same, the ownership percentage was exactly the same, but the actual amount was 10 times lower. So that would be like 1.1 1.06 million, and compare that to the compensation that the CEO gets, well, I'd say that their insider ownership is very insignificant and something that we probably wouldn't invest in it because of that. And as you know, I like to see a lot of insider ownership because it gives a lot of incentive for them to do a good job. If you compare that to Tesla, obviously you see the name Elon Musk, so you know it's Tesla, then you see a compensation of, well, this is very little. I'm not even sure if this is correct, but let's assume it's correct. It's 23.8k. I do think that Elon Musk has a very low compensation and just does whatever he does from the ownership perspective, but he has 18% ownership, so he has a significant stake himself in the company. That makes a big difference if you want to invest in a growth company, because then you actually know that the insiders have a decent incentive to grow the business themselves and not just wait for their yearly paycheck, or monthly paycheck I should say, and a yearly bonus for them to collect the money. As you can see, Elon Musk is the only one that has a significant insider ownership, and the moment you go to the second one is like 0.0059%. And if you look at the compensation, which is the yearly wages, is like 21 million US dollars compared to the 32.6 million. Obviously, he is very reliant on the compensation himself as well. And there we're talking about the chief financial officer. It's a significant compensation as well, but might be worth it, who knows. But I like to look at the compensation compared to the insider ownership amount and then see, okay, how great is their insider stake? How dependent are they on their ownership? That is what I would like to see, a management team that is quite dependent on their ownership. In general, when we look at these EV stocks, I think there's a lot of euphoria around it, but I think there are a lot of risks involved that are completely overlooked by the euphoria, or because of the euphoria. And the main point is, and that's what we just saw in the first part of the video as well, like the current establishment, all the current car companies who already have their brand out there, their factories, their sales points towards customers, all those car sales and all that. And yeah, I think when you look at an electric vehicle company, I think you should think about that. They are all facing the risk of going out of business if they don't switch to electric vehicles. Like we see more and more governments making rules and yearly goals to switch to electric vehicles, so they have to switch as well. And as you just saw on my Norwegian picture, you saw that there were already a lot of cars, electric cars, sold by the current establishment. And are we talking about that? I don't think so. If we think about electric vehicles, we do not think about investing in the current establishment. We want to have some hyped small cap stock who has the potential to grow significantly from a share price point of view. The increased competition is something that is also noticeable this year, of course, but it has been on as well. Like if you look at car companies in general, like there's already a big establishment out there, as I just mentioned, and I think the increased competition of all that, plus all these new stocks and like SPACs and all that go into the electric vehicle market, that is something that will eventually reduce prices, which is good for consumers and all that, and probably make better batteries and all that. It's all good, but from a shareholder perspective, you don't want all that competition. You want to have a product leader, you want to have a moat, you want to have high barriers to entry and all that. You want to have economies of scale. And increased competition, well, will not affect economies of scale, of course, but the fact that you have increased competition means that the high barriers to entry that you would like to see are not actually there, even though you are investing in a capital intensive industry, which means the automotive industry. We're talking about a new industry right now, at least that's the perspective of it. Electric vehicles are new, they're not the ICE vehicles, but keep in mind that the costs and the margins are actually pretty similar. How relevant is that? Well, in general, when you want to, I guess this also just proves the increased competition part. The moment you have higher margins, then you have probably lower competition because you can increase your prices without losing market share or sales in that regard. However, similar margins, like the margins aren't that great on the current automotive industry. Sure, there are highly profitable companies out there, but that is mostly because of their economies of scale and not because they have such a great profit margin of like 20-30%. No, they're very small margins actually. These small electric vehicle companies, they have no economies of scale. Maybe they will have it in the future, but as of yet they do not have economies of scale. That means that if the competition and the current establishment is able to produce a lot of electric vehicles, they will be able to probably cut these smaller electric vehicle companies in price just because they have lower costs, because they have their economies of scale. I think that is something that nobody wants to look at when you're looking at the EV small cap companies and the upcoming companies, but this is actually a significant part of becoming profitable at some point. And as you know, any thesis should have profitability at some point in their thesis. They lack the necessary moats. The big companies, they have moats in regards to the high costs of entry, like the high barriers to entry. Their factories that are all running, their brand names, all that. They're not great moats. Like I wouldn't say, okay, well, there's no competition, but their names are there, their brand is there, and all that. These new companies, they don't have that. They will have to do all the marketing, all that. It will also increase costs. And finally, the main issue with all this, in my opinion, is that they're all ideas, vision, and promises, and it will be. It is, I guess, from an investor point of view, it is very hard to define or to think about how the company is profitable. And I've shown you guys with Palantir that even if it is a high growth company, you can still have a cash flow thesis, a discounted cash flow method to calculate and all that. But if a company is like Workhorse in this case, it is all ideas, vision, and promises. And if there is no insider ownership, it is very hard to just, or at least for me, it will be very hard to just take that leap. And I know what you guys are gonna wanna say, but Tesla. And Tesla, yes, is the clear-cut example that electric vehicles can do very well and can be a great investment. And I do not own a Tesla. I am not an investor of Tesla, but I do love the cars. Like, I think they're amazing cars. But I think just because you have one successful electric vehicle company doesn't mean that all the others are going to be successful as well. There are some, I'd say, a few key takeaways that why Tesla is such a great company. The first one, they are the market leader in electric vehicles. That is as far as I know right now, and I don't think that they are going to be a market leader in electric vehicles in the future. And I'm not talking about the product, I'm talking about the market. So their market share in electric vehicles. I think that if Volkswagen is going to be able to overtake that position because Tesla is just not going to be able to offer the supply that the demand is asking for in the upcoming years. I think the demand will exceed whatever Tesla can produce. However, Tesla is a product leader on many aspects. On the electric vehicle, on the augmented reality, on the self-driving cars, all that. They are a product leader, and they are years ahead in regards of innovation and research and development. So that is a clear-cut advantage of Tesla. I think Tesla has a very unique CEO, Elon Musk. Obviously, we all know him. He has been the CEO of Tesla for over 12 years, which you don't see often in these electric vehicle companies. Like, if I'm wrong in there, please correct me. And Elon Musk is such a visionary. If you look at all the things that he's doing, or has done in the sense of PayPal. If you look at what he's doing right now, Solar City, SpaceX, all that. So to have a CEO like that with significant insider ownership, then you know that, yeah, the company is heading somewhere. That's at least what you can do. You can still argue, is this price worth for what the company is going to be in 10 years? Like, that's probably the arguable point. But regardless, you know that the company is heading somewhere. And finally, the company Tesla has a proven growth record. If you look at the statistics in sales, you see that over the past 10 years they have shown significant growth. And if you look 2 years ago, you saw a similar growth as well. So it's not like, okay, there's hindsight bias there. No, every year they have shown consistent high growth percentages on their revenue. Sure, the profitability part was always a bit questionable, but that's changed in the recent, I'd say, months, quarters, all that. But they had a proven growth record. They know that they were going to be a high growth company. Is that the case for these other electric vehicle companies? I wouldn't say so. I know there is a lot of potential, and I'm not gonna, like, as you know, I'm not talking about NIO here either. And like Tesla and NIO are not the companies in question that I talk about when I'm talking about these growth or these mentioned electric vehicle companies. But these are just on a different level already. They are not up and coming in that regard. So to say that Tesla is successful and therefore all the electric vehicle companies are going to be successful, I think that is a very long leap of faith, and I think people would be wise to be a little bit more hesitant into or before investing into these stocks or these electric vehicle stocks. So that's it for today, guys. Hope you guys enjoyed it. If you like these type of videos, please let me know down in the comments below. And as a reminder, if you want to see a full stock analysis on Tesla, and there will be like 3-4 videos that are probably a little bit longer, maybe even 5, then leave a like on this video, and then I'll get that up and running in the near future. Thank you guys for watching, and see you guys in the next video.